Hi everyone, I'm Michael Rosen, Chief Investment Officer for NorthStar Advisory Group. Today is April 9th, 2026, and the purpose of today's video is to discuss a little bit about how markets have performed in the start of 2026 and how NorthStar is navigating some of this volatility. We came into this year with technology and growth stocks basically lagging the market to finish weak at the end of 2025. Market conditions have basically broadened since the start of 2026. Areas like small cap, value, and international have really started the participation process, unlike previous years that have been led by growth stocks. Earnings season coming out of fourth quarter earnings in late January, early February, all look good. Earnings estimates and earnings expectations have actually risen. Starting this year, most investors, including ourselves, have believed that the Federal Reserve would basically be lowering interest rates, probably cutting short-term interest rates 2 to 3 times during the course of 2026. Now that we have entered this war in the month of March, and what looks like at least a pause or ceasefire in the war, creating some stability in markets, oil prices have increased from roughly $60 a barrel to over $100 a barrel. Actually, today I think we closed just below $100 a barrel. This is creating more cost inflation for consumers and businesses to ultimately have to tackle and deal with. This, in our opinion, will most likely put the Fed on pause in the short term, probably not wanting to utilize the word transitory that they have used in past. But the question will be is this cost inflation being caused by energy prices truly transitory, or is this with us? In NorthStar's opinion, I would say that energy prices most likely are not going to go back to where they were just a few months ago. Even if oil and gas prices start to correct, most likely they will correct to a higher level, probably crude oil somewhere in the $75 to $80 type range, keeping things a little bit more elevated, inflation probably stickier, and probably holding the Fed from probably cutting rates for most of this year. 2026 is also a midterm election year. Midterm election years are typically the lowest return of the 4-year presidential cycle. Average returns are roughly 6% in midterm election years. Typically, when you come out of the midterms in early to mid-November, the market usually finds its legs and usually has one of the stronger parts of that 4-year presidential cycle. Following returns from actual midterms are about 16 to 18% on average. So in our opinion, we want to be careful of markets basically in the coming months and coming quarters. Happy to see the markets basically bounce back as the S&P 500 started the year in the first quarter down almost 5. And in the last week or so, the market has rallied back to almost flat at this point in time. We believe that earnings season should be interesting because fundamentals have been fairly strong prior to the war. And the question will be is how are most businesses and management teams navigating through this level of volatility? And how is the consumer ultimately being sheltered through this period of time? As it relates to positioning within the NorthStar portfolios, again, we came into this year believing the Fed was going to be cutting rates and believing that the market would ultimately broaden out. Started to increase our allocation to some of the areas outside of growth in the fourth quarter of 2025. Areas like small cap, some value, and a little bit into the international. During the course of the war, you've seen a rally in the dollar, which is sort of negative for international assets. So we've really pared back a lot of those international exposure and even sold down some of the small cap and mid cap exposure due to the fact that they're more sensitive to credit and other conditions from an economic perspective. So in our perspective, we're trying to be more insulated and a little bit away from some of the more discretionary spending in the economy and a little bit more focused on the data center and the technology trade. See, technology sort of peaked, as I said, almost 6 months ago. Earnings expectations have risen by over 10% probably since that period of time, and those stocks have really underperformed by at least double digits, making the overall tech sector a lot more attractive from a valuation perspective. A little bit more on the hardware side, this is where all the money is getting spent by some of the largest hyperscalers like Microsoft, Amazon, Meta, Google. They're going to spend roughly $700 to $800 billion in capital expenditures towards building out these data centers for chips, servers, ultimately energy and other materials. So in the NorthStar portfolios, we've been underweight stocks to our equity allocations during this volatility, and we're going to be looking to increase that equity allocation as we get a little bit more color through this earnings season. Tomorrow, we will basically get a consumer price index, and it will be interesting to see how much hotter this data basically is, because this will be a print for March, to determine how the consumer is ultimately faring in this period of time. We do believe cost inflation is something that we're clearly watching, as are the overall markets. We will follow up with a video in about a month or so as we get more color throughout earnings season. Thank you for listening to our broadcast. If you have any questions, feel free to reach out to me or someone else on the team. We're here to help. Hope you're well. Talk to you soon.